Good morning and welcome to our Market Insight webinar. Today we will be covering the taxation of pension benefits, specifically looking at the changes introduced in last week's summer budget. I'm Paul Darlow and I'll be chairing today's session, and I'm joined today by Steve Hobbs, an actuary in our team and one of our leading experts on this subject. We will start today's session by looking at the Lifetime Allowance, before then moving on to the Annual Allowance. For each of these allowances, we will begin with a quick recap of how they work, before then summarising the changes introduced last week. We will then look at the implications of the changes before considering the actions that schemes and sponsors may wish to take. Before we start, it's worth just noting that we're still awaiting full details of exactly how some of the changes will operate in practice, and indeed towards the end of yesterday 200 or so pages of finance bill were published, which we will obviously need to look at in some detail, and so much of what we will cover today is still potentially subject to change. Now we've allowed time for a few questions at the end of the session, so please do submit questions as we go through the event, and you can do that by typing your question in the box shown on your screen. And we will post a Q&A document on our website shortly after today's webinar, covering any questions that we do not get time to answer on today's call. So we will start today with Steve providing a recap of how the Lifetime Allowance works.
Thanks, Paul. Good morning, everyone. The Lifetime Allowance is a limit on the total amount of pension benefits that can be built up by an individual over their lifetime. At its peak, it stood at 1.8 million, and following cuts in 2012 and 2014, it's currently standing at £1.25 million. A member can earn benefits in excess of the Lifetime Allowance, but they will pay a tax charge on any benefits that are in excess of it. The Lifetime Allowance applies only to benefits built up in registered pension schemes, since only these schemes attract favourable tax treatment. The value of a member's benefits is tested against the Lifetime Allowance at certain times known as benefit crystallisation events. For most people, the relevant time is when they retire and start taking their benefits. At that point, the value of their benefits is calculated and compared against the Lifetime Allowance. If the value of the benefits is greater than the Lifetime Allowance, a tax charge is payable. If the value of benefits is lower than the Lifetime Allowance, no tax charge falls due. For the vast majority of members, pension benefits are only tested against the Lifetime Allowance once. So people who have already retired, for example, are not impacted by the changes to the Lifetime Allowance, since the relevant test will have already been carried out. Changes to the Lifetime Allowance are most relevant to people who have not yet started drawing their benefits, as they have yet to be tested against the Lifetime Allowance. If a member does have benefits greater than the Lifetime Allowance, those excess benefits can typically be paid to the member either as a pension or as a cash lump sum. Some scheme rules may dictate exactly how those benefits would be paid. If excess benefits are paid as a cash sum, a tax charge of 55% falls due on any benefits above the Lifetime Allowance. If excess benefits are paid as pension, an upfront tax charge of just 25% is deducted. On the surface, it appears that these treatments are significantly different. However, the key point to note is that if a member takes excess benefits as pension, in addition to the 25% tax charge up front, they will also pay income tax on the pension payments they receive. So, for a 40% taxpayer, the overall effective tax payable on excess benefits is the same whether they are taken as a cash lump sum or as a pension. So how do you determine whether or not a member's benefits exceed the Lifetime Allowance? For defined contribution benefits, the test is straightforward. For most members, the value is simply the DC fund value on the date of the benefit crystallisation event, although it can get a bit more complex if the member is entering drawdown. Defined benefits are more complex. Any cash lump sum is treated the same as a DC pension pot, i.e. it is taken at face value. However, to calculate the value of the pension, you must multiply the annual amount of the pension by a factor of 20. So let's look at the member illustrated on this slide. He receives a cash lump sum from his DB pension of £300,000, which is valued at face value, i.e. £300,000. On top of this, he receives a DB pension of £50,000 per annum. Multiplying this pension amount by the valuation factor of 20 gives the value of this DB pension of £1 million. His DC funds are taken at face value, namely £200,000, and so his total pension benefits are valued, for lifetime allowance purposes, to a total of £1.5 million. An interesting feature of this methodology that has been widely criticised is the crudeness of the DB valuation factor of 20. This factor is the same whether the member retires at 55 or 75, and it is the same whether the pension increases at 5% per annum or doesn't increase at all. Whilst those pensions have vastly different values from a common sense perspective, they have the same values for lifetime allowance purposes. One simple thing that members can do, therefore, to mitigate against the impact of the lifetime allowance is to bring forward the date of their retirement, since the starting amount of their pension will reduce. Whilst the value of that early retirement pension might be equivalent from an actuarial perspective, it has a lower value from a lifetime allowance perspective, and this is something that we will consider in more detail later. So that was a quick recap of the lifetime allowance itself. We will now look at the most recent changes to the lifetime allowance. And this is fairly straightforward. The lifetime allowance is again going to be reduced from the current level of £1.25 million to £1 million from next April. And to protect members who had been planning to use a lifetime allowance of £1.25 million, new protection options are to be introduced. Whilst we do not yet have the information on how these protections will operate, we expect them to be similar to the fixed and individual protection options that were available in 2014. The expectation is that from April 2018, the lifetime allowance will then begin increasing in line with inflation. However, if you cast your mind back to 2006 with the introduction of the lifetime allowance, the stated intention then was to also increase the lifetime allowance each year in line with inflation. But as we all know, however, the LTA hasn't increased for a number of years. Rather, it has been progressively and dramatically cut back. Members will likely, therefore, take this expectation with a pinch of salt. So if we now revisit our earlier example of the member with benefits valued at £1.5 million from a lifetime allowance perspective, his benefits will be worth £500,000 more than the new lifetime allowance. So if he doesn't have any protection, a tax charge will fall due on the £500,000 of excess benefits. If those excess benefits are taken as a cash lump sum, a tax charge of around £275,000 will fall due. This compared to the position before the reduction in the lifetime allowance, where the tax due would have been £137,500, so the tax charge has doubled. Or more importantly to the member, the amount of benefits they must give up in order to meet the tax charge has doubled as a result of the cut in the lifetime allowance.
So we'll now come on to look at the implications of these changes for pension schemes. Firstly, many more people will be impacted by the lifetime allowance in the future than that would have been before. And whilst £1 million sounds like, and indeed is, a lot of money, it doesn't equate to a particularly large pension. In a DC pension scheme, where it's the fund value that's tested against the lifetime allowance, you can see how individuals with good but not massive salaries could easily generate pension pots of £1 million or more thanks to compound investment growth over a number of years. And in particular, people who are still some years away from retirement and who have significant pension pots may not realise that investment growth alone could take them over the lifetime allowance. And on this slide, we show two example members in defined contribution schemes. Firstly, and rather surprisingly, a 25-year-old with a salary of £30,000 who, on average, gets 10% of their salary paid into their pension each year up until 65, would expect to have a pot of just over £1 million at retirement, assuming that they achieve good levels of income growth over their career and get 6% return each year on their pension pot. Secondly, a member who's 10 years away from retirement and who has a pension pot of £600,000 would also expect to breach a lifetime allowance of £1 million at retirement just through investment performance. In a DB scheme where the pension is multiplied by a factor of 20 in order to assess its value, a lifetime allowance of £1 million equates to a pension of £50,000 a year. And so members with long service and or high salaries could easily breach the new lifetime allowance. And it's not just members who are still earning benefits in DB schemes who could be impacted. People with sizable deferred pensions who are still some years from retirement could expect to breach a lifetime allowance of £1 million, just a result of the annual increases that are applied to deferred pensions. For example, a member who is 15 years away from retirement age with a current deferred pension of just £32,000 a year would expect that pension to increase through deferred revaluation to a pension of around £50,000 a year by normal retirement age. He would therefore be very close to breaching the lifetime allowance. At a level of £1 million, therefore, the lifetime allowance is something that will affect not just the very highest earners in an organisation, but increasingly it will start impacting more mid-level employees. Members, therefore, are likely to want to know whether they will be impacted by the lifetime allowance, and if so, they'll want to know when. They'll also want to understand what they can do to mitigate the impact. One thing DB members in particular could do is to draw their benefits earlier, since, as Steve mentioned earlier, doing so will give those benefits a lower value from a lifetime allowance perspective. So let's just look at a quick example. A member may be entitled to a pension at age 65 of £55,000 a year, and this pension on the lifetime allowance test would be worth £1.1 million, which would clearly exceed the new lifetime allowance of £1 million, and therefore tax would be due. However, rather than retiring at 65, the member could instead choose to retire 3 years earlier, at age 62. And because the pension is paid sooner and for longer, it would be reduced for early payment, perhaps to £48,000 a year. £48,000 a year would have a lifetime allowance value of £960,000, and so no tax charges would fall due. Now, that early retirement would be cost neutral from an actuarial perspective, meaning that the member would expect to be no worse off in terms of the money they receive over their lifetime. However, from a lifetime allowance perspective, the early retirement option has distinct advantages, and as tax charges would not be payable, the member effectively retains the full value of their pension benefits rather than paying some of those away to meet tax charges. Similarly, taking the maximum amount of tax-free cash possible is likely to reduce the value placed on a member's benefits. And indeed, some pension schemes give members the option to exchange some of their own pension in return for the provision of a higher spouse's pension. Again, from a lifetime allowance perspective, doing so will be advantageous to the member, since the valuation factor of 20 is such a crude metric, and it's independent of the level of spouse's pension provided by the scheme. Members whose current benefits are likely to breach the lifetime allowance are likely to want to consider ceasing any voluntary contributions that they make, and they may even consider ceasing all pension accrual. And this is particularly likely to be attractive where an alternative form of remuneration, such as a cash salary supplement, is available instead. And of course, members will also want to know whether or not they are eligible to obtain one of the new forms of lifetime allowance protection that is to be introduced. So that's the member's perspective. From a trustee perspective, we think trustees are increasingly likely to want to help members understand this issue, both generically and also in terms of how it impacts them specifically, since without some assistance, many members will struggle to understand this topic. And so, as well as updating member booklets and other scheme documentation, we think many trustees will issue communications to members to inform them about the changes and help them to understand their options. And if these communications are going to help members to truly understand what the changes mean for them, some analysis of each member's specific pension position will be needed. From a practical point of view, administering pension schemes will become more complicated with the introduction of yet more protection options. And on top of that, pension schemes will need a policy for calculating how much of a member's pension needs to be given up in order for the pension scheme to pay the tax charge on the member's behalf. And so each scheme will need to determine appropriate factors if they don't already have factors in place, and each scheme will need to implement a policy for making this happen. And from the perspective of companies, ultimately pensions are no longer a particularly tax-efficient way of providing high earners, or those with long service, with remuneration. Of each £1 of pension accrual in excess of the lifetime allowance, only 45 pence of it reaches the member. And if the member is also impacted by the annual allowance, which we'll come on to later, even less of that pension spend reaches the member. The majority of it will go to HMRC. We therefore think that companies who employ significant numbers of high earners will probably want to take a fresh look at their overall pension strategy to determine whether or not continuing to provide the current level of pension to employees remains sensible, or whether alternatives may be more appropriate. Now, ultimately, trustee and company interests can be aligned here. Using the company's limited pension budget to fund additional benefit accrual, which largely ends up in the hands of HMRC, is unlikely to be attractive if an alternative strategy can be found that results in either savings to the company, increased benefits to members, or an increased level of security to benefits that have already been earned. Now, back in 2013-2014, when the lifetime allowance last reduced, many companies decided to proactively identify those members who were going to be impacted and speak with them to make sure that they understood how they were going to be affected. And in many cases, companies then offered these employees the option of a cash salary supplement if they decided to stop earning extra pension benefits. And we saw a number of employees accept such offers. And structured correctly, this can genuinely be a win-win. Members can get a higher level of total post-tax remuneration for a lower cost to the employer. Now, lastly, from the company's perspective, the reduction in the lifetime allowance may also impact some planned de-risking activities. Pension increase exercises at retirement, for example, would be less attractive to members with larger pensions, since having a higher initial starting pension would be more likely to push members over the lifetime allowance. Similarly, on the subject of DB to DC transfers, they're likely to be less appealing for people with large pensions, since the valuation factor of 20 used to value pensions in the DB environment is very generous compared with the sort of fund value approach that's used in the DC environment. So that's a quick run through the lifetime allowance. We'll now look at the annual allowance.
The annual allowance is a limit on the pension benefits that can be earned by a member in any 1 year. To date, schemes have had some flexibility in choosing the 12-month period over which to test the annual allowance. It could be tax years, calendar years, or some other 12-month period. The 12-month period chosen by a scheme is referred to as its pension input period, or PIP. The annual allowance currently stands at £40,000 each year, and like the lifetime allowance, it applies only to benefits built up in registered pension schemes. A member can earn benefits in excess of the annual allowance in any 1 year, but they will pay a tax charge on any benefits that are in excess of it, unless they have any unused annual allowance from preceding years. This can be used to offset any tax bill. This unused annual allowance is known as carry forward. To determine how much carry forward a member has, you look back at the last 3 tax years and compare the value of the member's pension accrual with the annual allowance. If the value of the accrual in any 1 year is lower than the annual allowance, the difference can be carried forwards. So if, for example, a member exceeds the annual allowance by £10,000 this year, but has carry forwards of £28,000 available, then no tax is due. Over the last few years, we've seen a large number of members, particularly high earners in defined benefit schemes, needing to use their carry forward to avoid having to pay an annual allowance tax charge. These high earners will often no longer have any carry forward left, and so even in the absence of changes to the annual allowance, we would expect more and more people to begin paying annual allowance tax charges as a result of having exhausted their carry forward. If a member exceeds the annual allowance and does not have sufficient carry forward, any excess accrual is treated as income and taxed as such. This means tax of 40% or 45% or even a combination of both, depending on how much other taxable income the member has for the year in question. Calculating the amount of tax due can therefore be quite a complicated matter for individuals, especially when they run into annual allowance problems for the first time when the process and legislation are unfamiliar to them. The tax charge that falls due can either be paid by the member, in which case it will be paid out of the member's post-tax income, or the pension scheme might pay it on the member's behalf. If the pension scheme does pay the tax charge on the member's behalf, it will then reduce the member's pension by an amount deemed to be equal in value to the tax due. This mechanism is known as scheme pays. For a defined contribution member, determining the value of 1 year's pension accrual is straightforward. It is equal to the amount of contributions paid in that year by both the member and the company on their behalf. For a defined benefit member, it is significantly more complicated. Step 1 is to determine the amount of the member's accrued pension at the start of the year. You then add 1 year's inflationary increase to that pension and multiply it by a valuation factor of 16. It's worth noting here that the valuation factor of 16 is lower than the valuation factor of 20 used for lifetime allowance purposes. Step 2 is to determine the amount of the member's accrued pension at the end of the year and again multiply that by a valuation factor of 16. The value of the year's pension accrual is then the difference between those two amounts.
So let's consider an example DB member. At the start of the year, member A has 20 years service in a defined benefit pension scheme and has a salary of £60,000. At the start of the year, therefore, his pension, in this case, is 20/50ths, multiplied by his salary of £60,000. Allowing for 1 year's inflationary increase gives an accrued pension of £24,720. Multiplying the pension of £24,720 by a valuation factor of 16 gives the value of that pension of £395,520, and that's the value of the member's pension at the start of the year. So that's step 1 that Steve just talked through. Step 2 is to calculate the pension at the end of the year. At the end of the year, he has 1 extra year's worth of accrual, so 21 years rather than 20 years, and over the year he's received a significant promotion, and so his salary has increased from £60,000 to £70,000. At the end of the year, therefore, his pension equals £29,400 per annum. Multiply that by a valuation factor of 16, gives the value of £470,400. The value of his pension accrual over the year, therefore, is equal to £470,400 less £395,520, which equals £74,880. Now, unless the member has carry forward available, he will therefore incur an annual allowance tax charge. But because this member has only breached the annual allowance thanks to a significant promotion, in fact, it's quite likely that he will have carry forward available, and hence this member may not have to pay an annual allowance tax charge. Another group of members who can be impacted by the annual allowance are high earners with long service. So let's look at another example. And at the start of this year, member B has 30 years service and a salary of £125,000. Following step 1, we calculate the amount of his pension at the start of the year and allow for 1 inflationary increase. This gives a pension of £77,250 per year. Again, we multiply that by the valuation factor of 16, and that gives us a value of his pension of £1.236 million. At the end of the year, again, he has 1 year's additional accrual, and in this case, this member's salary has increased only slightly. So under step 2, we calculate again the amount of his pension, which equals £81,840. We then multiply that by the valuation factor of 16, which gives a value of £1.31 million. The value of this member's accrual over the year, therefore, is equal to £1.31 million, less £1.236 million, which equals just over £73,000. Now, this member didn't have an unusually large pay increase over the year, and so his pension accrual this year is probably quite similar to what his pension accrual was in the previous years. And so this individual is unlikely to have any significant carry forwards remaining, and so this member is likely to face a tax charge.
So that's a quick recap of the annual allowance itself. We will now come on to look at the most recent changes to the annual allowance. Firstly, let's look at individuals with taxable income of less than £110,000. The good news is that for these individuals, the annual allowance is not changing and it remains at £40,000. Everyone else will be or may be impacted by the latest changes. People with taxable income of more than £110,000 will need to calculate the amount of their pension savings in a year. This is then added to their taxable income for the year in order to calculate their adjusted income. If adjusted income is less than £150,000, then there is no change and their annual allowance will remain at £40,000. Anyone with adjusted income of more than £150,000 will lose £1 of annual allowance for each £2 of adjusted income over 150k. There is a minimum level of annual allowance, £10,000. Based on the formula for the new tapered annual allowance, this £10,000 limit would apply to members with adjusted income of £210,000 or more. And this change applies with effect from 6th of April next year. The way an individual's annual allowance changes in response to his or her adjusted income is shown on the graph. These changes are clearly not straightforward, and in particular I wanted to highlight 2 points. Firstly, members of defined benefit pension schemes will not know their adjusted income until after the end of the year. They will therefore also not know in advance what their annual allowance for the year will be, and hence whether or not they are going to breach it. This makes tax and pension planning particularly difficult for these individuals. Secondly, calculating adjusted income for members of defined benefit schemes is not a straightforward piece of analysis. The fact that it needs to be undertaken for every member with an income of more than £110,000 means that administering the benefits of people with income of more than 110k will become significantly more complicated once these changes are introduced next April. It could be that scheme administrators do not hold enough information in order to determine an individual's adjusted income. For example, the scheme might only pension and therefore hold a record of someone's basic salary. Similarly, administrators are unlikely to have details of any contributions paid into other arrangements by the member over the year. This means the administrator may not be able to accurately assess whether somebody has exceeded the annual allowance. So let's look at an example of how this works. To do so, we will revisit member B. If you recall, this member was a long-serving member of a DB pension scheme with a high salary. The value of his pension accrual over the year was £73,440. Let's work out his annual allowance. The first step is to work out his adjusted income. To do this, we take his taxable income of £132,000 and add back the value of his pension accrual over the year, which was £73,440. That gives an adjusted income of £205,440, which exceeds the £150,000 threshold above which the annual allowance is reduced. Step 2 is to work out the amount by which his adjusted income exceeds the £150,000 threshold. In this example, the answer is £55,440. Because his adjusted income is greater than £150,000, he therefore loses some of his annual allowance. Specifically, he loses £1 of annual allowance for each £2 of adjusted income in excess of £150,000. Since we know that his adjusted income is £55,440 more than the threshold, we also know that he loses £27,720 of annual allowance. Therefore, his annual allowance for the year is £40,000 less £27,720, which equates to £12,280. Given that the value of his pension accrual over the year is £73,440, he has therefore breached his annual allowance by £61,160. Should no carry forward of unused allowance be available, this entire £61,160 would be subject to income tax, and the member would be facing a significant tax bill. Or, if they chose to use scheme pays, they would suffer a reduction in pension equivalent in value to the £27,000 or so of tax that the scheme has paid on their behalf. All parties involved clearly face a significant communication challenge in making sure that affected people understand this. As if this wasn't complicated enough, the government has also announced some changes to the way in which pension input periods operate. To recap, a pension input period, or PIP, is the 12-month period over which a member's pension accrual is valid for the purposes of determining whether or not their pension accrual exceeds the annual allowance. I won't discuss this in too much detail today, since for the majority of members it is not particularly relevant. However, it is worth knowing that with effect from April 2016, all pension input periods will run in line with the tax year. This is in stark contrast to the position where the scheme had flexibility in choosing its own PIP. To start transitioning schemes towards this, all PIPs that were open on 8th of July ceased, and all schemes now have a new PIP that started on 9th of July and will end on 5th of April 2016. Because of the introduction of this additional short PIP, individuals will now have at least 2, possibly 3, pension input periods ending in the tax year. To ensure that members are not disadvantaged by this, all individuals will have a refreshed annual allowance of £40,000 for the mini PIP that started on 9th of July. Having this refreshed PIP may provide those with sufficient disposable income with the opportunity to make additional pension contributions before their allowances may change next April.
Okay, so what are the implications of these changes for pension schemes? Well, firstly, like the lifetime allowance, many more people will be impacted by the annual allowance in the future than have been before. Many members will have already used up their carry forward, and so the reduction in annual allowance for high earners is likely to result in many more people facing a tax bill than was previously the case. Secondly, working out who will be impacted, and indeed working out how they will be impacted, will be much more complex than before, particularly in defined benefit pension schemes. Defined benefit members with income over £110,000 will need significant additional information and support to understand whether or not they will be impacted by the tapering of the annual allowance. And defined benefit pension schemes containing members with income greater than £110,000 will become much more complicated to administer. With an annual allowance of as low as £10,000, high earners who are lucky enough to be earning benefits in a DB pension scheme are likely to find themselves questioning whether or not they want to continue doing so. Many of them, in fact, could find themselves better off by becoming a deferred member of their defined benefit pension scheme, paying £10,000 into a DC scheme and receiving a salary supplement from their employer instead. Of course, that will require the agreement of the employer, and we think many employers will be only too willing to offer this, since doing so could not only be in the employer's interests, but also in the interests of their employee. So what actions do we think trustees and sponsors should be considering? Well, we think the first step should be to understand how many people in your scheme will be impacted by either the lifetime or annual allowance, and when. That, combined with analysis of the likely sums of money involved, will help you to understand whether the most recent changes are only going to affect a very small minority of your members, with only a small amount of money being paid to HMRC as tax charges, or if it's going to impact a much larger percentage of the scheme, with a large amount of money expected to be paid to HMRC as tax charges. And I think the answer to those questions will, to a large extent, determine whether this is an area where sponsors decide to proactively revisit their overall reward strategy and consider making changes to ensure that it remains appropriate, or whether actions will fall solely on the trustees, namely managing communications with members, together with managing the smooth operation of the new lifetime allowance protection regimes, scheme pays, and the policy for paying the annual and lifetime allowance tax charges. So that concludes today's presentation. We've had a lot of questions, and I don't think we'll be able to get to all of them today, but we will take a couple of them now. And the first question is, you said that the reduction in the lifetime allowance could have implications for de-risking exercises. Can you expand on this? And Steve, I don't know whether you want to take this one?
Yeah, sure. Here we're referring to exercises where the company may be looking to reduce or control risk associated with their pension scheme. An example of this is a pension increase exchange where members are given the option to reshape their benefits on retirement. They can give up some of their pension increases in return for a higher non-increasing pension. This can be used to reduce the inflation risk under the scheme, and it can lead to cost savings for the sponsor depending on the terms offered to the exchange. Given the lifetime allowance test is based on the level of pension actually put into payment, by increasing the starting pension under the pension increase exchange, it could push some members over the lifetime allowance. The reduction in the lifetime allowance means that this would affect more individuals. It means members are less likely to take up the exchange option, as the tax charge incurred could make the pension increase exchange less attractive, and the potential cost savings that the employer could make are reduced. It's particularly true given that these members will have the larger pensions. They'll represent the larger liabilities of the scheme where the larger savings can be made. Transfers from DB to DC schemes is also a hot topic for risk reduction at the moment. Members may choose to give up their DB pension in return for a transfer value being paid into a DC scheme. Under the DC scheme, members would then be able to flexibly access their pension savings and potentially opt for a higher tax-free cash lump sum and pension. Transfer from the DB scheme removes risk, or the risk associated with providing that pension under the sponsor scheme, and again can lead to cost savings for the employer. The member might find that they would become subject to a lifetime allowance tax charge under the DC scheme, whereas if they had kept their benefits under the DB scheme, no such tax would have become due. It's basically because the DB valuation factor of 20 understates the true value of a member's pension.
So there's a few other questions that we'll try and take now. The first one, can we have copies of the slides, please? And the answer is yes. The slides will be made available on our website after the conclusion of today's session. It probably won't be until either tomorrow or Monday until they're uploaded onto the website. Another question is, must pension schemes offer the scheme pays facility? Steve, I don't know whether you want to take this one.
Yes, when the annual allowance was reduced, they brought in the scheme pays option. And under certain conditions, the scheme must offer scheme pays to the member. The situation is where the tax charge is greater than £2,000 and the member has exceeded the annual allowance in the pension scheme itself. The scheme can do voluntary scheme pays if they wish and perhaps pay a tax charge of less than £2,000 for the member. But typically they just go down the compulsory route and provide only what they need to do under legislation.
Okay, thanks, Steve. We had a question about how the lifetime allowance works if a member has multiple crystallisation events. So let's say someone has already taken tax-free cash and a pension from their defined benefit pension scheme, let's say 2 years ago, but they continued to work and also paid into a DC scheme, and at some point in the future they then crystallise that DC scheme. So in that case, you've got two different benefit crystallisations event, one when the member takes their benefits from the DB scheme, and one when the member takes their benefits from the DC scheme. And the question is, how does the LTA work from that perspective? And again, Steve, I don't know whether you want to take that one.
Well, what would first happen is, when the member retires under the DB scheme, the administrator would place a value on those benefits to test them against the lifetime allowance. As we discussed earlier, they would take the cash lump sum, that would be taken at face value, and they would then add on 20 times the pension that was put into payment, which would give them a lifetime allowance value. And what they then do is they equate that value to a percentage of the lifetime allowance. So let's say, for example, when the member put their DB pension into payment, they used up 75% of the lifetime allowance at that point in time. The member would then have 25% of the lifetime allowance going forward. If that member then joins a DC scheme, paying contributions into that arrangement and building up a pot, when they subsequently come to retire under the DC scheme, the administrator would look at that pension pot and would have to test that against the member's remaining lifetime allowance. So if that DC pot was worth, say, 20% of the lifetime allowance, but the member had 25% still available, no tax charges would become due. If, however, the DC pot was worth 30 or 40% of the lifetime allowance, the member would have exceeded the available lifetime allowance that they had left, and tax would become payable.
Okay, thanks, Steve. There's one other question that I think we'll take now, and the question is: we have a defined contribution scheme, and we also have a closed defined benefit pension scheme that has salary linkage. And the question is: do the calculations have to include the values in the defined benefit pension scheme? And by that, I think the question is probably referring to the annual allowance, and specifically whether the DB scheme, the fact that it's closed but that members still have salary linkage, whether that counts towards a member's annual allowance for the tax year. So again, Steve, I don't know whether you want to take that one.
Yeah, this is quite a common situation that we see at the moment, with a lot of employers closing DB pension schemes and replacing them with a DC arrangement. If no salary linkage was provided and the member was just a purely straightforward deferred member at the start and the end of the pension input period, then the defined benefit deferred pension could be forgotten about, and you would just look solely at the contributions being paid into the DC arrangement. However, because that salary link has been provided, you do actually need to take into account the value of that increase in deferred pension over the year for the purposes of the annual allowance. And if somebody receives a reasonable pay rise in excess of inflation, then you could see that the value of that increase in the deferred pension, by virtue of the link to the salary, does use up some of the individual's annual allowance.
Thanks, Steve. We'll now bring this webinar to a close. A recording of the webinar will be available on the website in the next couple of days. And we will also issue a Q&A document on our website covering those questions that we have not covered on today's call. And we'll also provide answers to the ones that we did cover on today's call, just so you can have written copies of those. If you'd like to discuss any of the topics covered today in more detail, or if you've got any questions on today's session, please either contact your usual Xafinity consultant, or alternatively myself or Steve would be delighted to help. So thank you all for joining. I hope it's been a good use of your time. And could I just ask you please to spend a few seconds as you leave completing the exit feedback questionnaire. Thank you very much and have a good day.